Hello, this is Carrie Tallerty of New Cannabis Ventures. Today I'm speaking with Andrew Grieve, the CEO of licensed producer Zenabis. We'll be talking about the company's footprint, brands, and funding. Thank you for joining me today, Andrew.
Thank you very much for having me.
It's our pleasure. First off, can you talk about what you think differentiates the company from its competitors?
I think what is very important to understand about Zenabis is our pace and our values. From a pace standpoint, Zenabis was actually quite a small licensed producer as of January when we created Zenabis through the amalgamation of Bevo and Sunfarm. At that point in time, we only had about 5 tons of production capacity. And at this point in time, we have more than 50 tons of production capacity. And we achieved that, of licensed production capacity, we achieved that in about 8 months. From here, we should be at our full initial build out of more than 140 tons of licensed capacity by the end of the year. And therefore, what you can see is an incredible pace in terms of construction and licensing, going from 5 tons to 140 tons in less than a year. So pace is definitely something that differentiates us from our competitors. The other thing that I think is important to understand about the business is that we really are a values-based business. And our values are compliance, responsibility, excellence, and delivery of stakeholder value. And those values influence and drive every decision that we make. And therefore, when we have any conversation in the company, compliance is always a component of the discussion. Whenever we talk about the solution to a problem, we always want to ensure that we incorporate the value of excellence into the solution we come up with. Whenever we talk about how we interact with others within the company, we always try and take personal responsibility for our actions. And then every conversation is always framed around delivery of stakeholder value. And that doesn't just mean shareholders, it also means value for our employees and also for the communities in which we operate. And delivering value for the communities in which we operate is a really important component of being a good partner and results in having strong community support.
Next, I'd like to talk about your background. You are an experienced entrepreneur and financial executive. What led you to the cannabis space and Zenabis?
What led me to the cannabis space and to Zenabis in particular is I actually worked with the family that previously were the majority owners of Bevo Agro, which was one of the components that came together to build Zenabis. And I'd started working with the Benne family from Bevo on a controlled environment agriculture business called Cubic Farms. And I worked with them from essentially the point of inception of Cubic Farms all the way up until the point of the company being listed. And when the family considered entering the cannabis space, they asked for my perspective and asked for my assistance. Because I ended up putting together the amalgamation of Sunfarm and Bevo to create Zenabis, the board of directors of Zenabis, the new company, asked if I would come on as the CEO. And so even though this isn't something that you would expect based on my past background of a focus on finance and technology ventures and the military, it really is consistent with some of the things I've done in the past from a business standpoint, where you want to move really quickly, build something really fast, and build something based on the principle of excellence.
Now, who are some of the other key members of the company's leadership team?
Other key members of the company's leadership team include Benne. He has more than 30 years of experience in industrial scale agriculture and cultivation, and he built Bevo from 2.5 acres up to the more than 50 acres of greenhouse capacity at the point in time of the amalgamation. He's our chief growing officer. He's amazing when it comes to everything you could possibly want to know and understand about cultivation, from the facility standpoint to the plant standpoint to absolutely everything. We have a fantastic chief revenue officer in David Lluncor with an incredible amount of experience in both consumer packaged goods and in the grocery side of the business, which allows us to have great relationships with a wide variety of potential counterparties ranging from provinces all the way to grocery stores and other retailers. We have a great CFO in Mike Smyth. He actually was the CFO of SunSelect when they sold to Canopy. So it's a great advantage to have him on the team. Our Senior Vice President of Operations, Parbinder, who works out of our facility in Appleville, has an incredible amount of experience in manufacturing, packaging, and automation. We really have built a team that I think is the right team for where the cannabis industry is at the moment. And it's a team with shared values. And again, those values are the company's values, which are compliance, responsibility, excellence, and delivery of stakeholder value.
As you mentioned, the company was formed in January of this year following the reverse takeover of Bevo by Sun Farm. How do you view the evolution of the company's business model since it first began?
Prior to the amalgamation between Bevo and Sun Farm, as I mentioned before, was a licensed producer with 5 tons of capacity, and there were a limited number of players in the market with scale. We've really gone from being quite a small producer to a very meaningful producer, and we're going to be an even more significant producer in the very near future. And by the end of December, I'm not sure exactly where everyone else is going to be at from a capacity standpoint, but as I mentioned, we will have transformed from a relatively small licensed producer into a very meaningful participant in the market. But it's not just about having capacity. It's about having the products that people want. And that doesn't just mean having the right flower products. It also means having the right pre-roll products, having the right specialty flower products, but also starting in December, it means having the right value-add products. And once the market transitions away purely from flower to these additional value-add products, you'll then be in a position where it's going to be much easier to differentiate between companies based on brand and product. And so what you'll see from December onward is the company's business model will still at its core include an incredibly low cost of cultivation and cost of production for flower products and achieving meaningful distribution, because we have distribution in 9 provinces and 1 territory right now. But at that point in time, we'll also be in a situation where we can differentiate from a product standpoint, from a brand standpoint, as a result of having these value-add products and being able to come up with unique delivery methods and unique formulations.
Can you tell us what the company's license footprint in Canada looks like right now?
Yeah, at the moment we have 4 licensed facilities. We have a 25,000 square foot indoor facility in Delta, which is focused on extraction and value-add manufacturing. We have a 460,000 square foot facility in Langley, which is part of a 2.1 million square foot overall greenhouse. We are in the process of getting the remainder of that 460,000 square feet licensed at the moment. We have a 255,000 square foot licensed facility in Stellarton, and we have a 380,000 square foot licensed facility in Appleville, which is essentially complete and is waiting for 4 rooms to be licensed at the moment. That's our footprint from a facility standpoint with regards to cannabis. And then on top of that, we have a facility in Aldergrove in British Columbia, which is 10.5 acres of greenhouse that we use for our floral and propagation business. And we have another 5 acres of greenhouse in Pitt Meadows in British Columbia, which again we use for floral propagation and for the cultivation of hemp.
Can you talk more about the company's distribution and retail presence in Canada?
Absolutely. From a distribution standpoint, as I mentioned, we're in 9 provinces and 1 territory. And so the only province where we don't have a presence at the moment is Newfoundland. And then we're also in the Yukon. So I mentioned only 1 territory. We also have medical distribution through Shoppers, and we have a strong relationship with PharmaSave, as well as our own online medical distribution, which we're in the process of meaningfully upgrading.
You've talked about the importance of brand. What does the Zenabis brand portfolio look like?
Currently, the Zenabis brand portfolio is comprised of Namaste, which is our premium recreational brand, and Founders Reserve, which is our upcoming or our soon-to-be launched microcultivation brand. So we have relationships with microcultivators through a program called Zen Craft Grow, and very shortly we anticipate having one of the first microcultivation licenses through one of our partners. And so we have a brand that's just dedicated to microcultivation. We have a value brand called Re-Up, which actually just launched, which is for selling a certain value pre-rolls primarily, so 1 gram pre-rolls. And then we have other brands that will be coming out in the future. And at the moment, Zenabis is also our medical brand.
Next, let's talk about the company's international platform. Zenabis has plans in Malta, the EU, and South America. How are these plans progressing?
The plans are progressing very well. As we previously noted, we anticipate having shipments to the EU in the fourth quarter of 2019. And we're currently making an incredible amount of progress on our plans for the EU, and in particular, based on shipping through Malta. So that's really our international focus at the moment, is having access to the entire European Union through our Malta joint venture.
Now, are there any additional markets the company plans to pursue in the near future?
There are actually a significant number of markets the company plans to pursue in the near future, but you'll have to wait and see, because we wait until we have definitive agreements before we announce our partnerships and entry into other markets.
Absolutely. Next, I'd like to talk about funding. The company has done several different financing deals since it formed. Can you talk about the company's approach to raising funds and then allocating capital?
The company's approach to raising funds has really been focused on minimizing dilution and finding innovative ways of securing capital. If you look at our prepaid supply agreement deals, for example, we were able to receive $40 million in cash by offering product to be shipped over a period of time to counterparties Tilray and Starseed. And therefore, there was no requirement to take any dilution. And the other way of looking at that is we traded a limited percentage of our 2020 volume for cash that was non-dilutive at pricing that's still profitable for us from a marginal cost standpoint. So that's something that you haven't really seen in the market at the scale that we've completed these transactions. We've also completed other financing transactions that are not necessarily in line with everything that others have done. So as an example, we used our greenhouse collateral pool to source $51 million of financing from BMO. But on the indoor collateral pool side, we recently took an extra $25 million of financing in senior financing that had very limited dilution. So if you compare that to other approaches that people have taken, what we selected is we chose to have a slightly higher coupon, so pay a higher interest rate, but have significantly less dilution. So when we completed that financing, we only needed to offer 5% warrant coverage. So we sourced senior financing, and we only gave up 5% of that financing amount in terms of potential equity dilution. But the other option that we had at that time, based on where the market is at, would have been to do a convertible deal at a slightly lower interest rate, but have full convertibility and to have additional warrant coverage. So you've seen deals in the market where there's full convertibility and up to 112% warrant coverage, which means for every dollar that you receive in the door, you took more than 2 times potential equity dilution. And when we sourced incremental senior financing, we took 5 cents of equity dilution for every dollar we took in the door. And the additional cash interest that we had to pay on that was limited relative to the dilution savings. So these are some things that others aren't necessarily doing in the market, but anytime we look at a problem, we always want to pursue every possible alternative and find the best possible solution for our shareholders. And in this case, limiting the dilution to 5% was definitely preferable to taking 200% dilution in doing a standard market convertible deal.
Now that you've done this fundraising, how is the company approaching allocating the capital at its disposal?
Really, that funding was just to complete the initial 143 tons of construction and provide sufficient working capital to be cash flow positive. So from there, we expect to have surplus capital, and we expect to be allocating that to some different and innovative products and innovative approaches to expanding our business going forward.
As you mentioned, there's a surplus of capital. Do you see a need to raise more in the near future?
We don't currently see the need to raise more capital.
Okay. So Zenabis reported $25 million in Q2 revenue. Can you offer any insight into revenue and growth projections for the full year, either specific numbers or a general overview?
I can't, because we haven't provided any guidance to the market at this time. But what I can say is that we've provided guidance on our cultivation. And what it's possible to do is look at our cultivation output and then use that to estimate what our revenue is going to be going forward. And in general, well, not in general, in the past, we've always beat the monthly guidance that we put out as a cultivation forecast. And the outperformance has ranged from limited outperformance to very meaningful outperformance versus our forecast. And so we believe that the cultivation outputs that we put forward as guidance are very reasonable forecasts. And therefore, we believe it's possible to take those very reasonable forecasts and come to an estimate as to potential revenue, because we also provide guidance on how long it takes to convert harvested product into revenue.
Now, what metrics do you recommend investors use to track the success of the company?
We believe that the most important metrics to track success of the company are metrics that are a mix of forward-looking and current metrics. And therefore, what I believe is most relevant is your license capacity, your near-term production capacity, and then what your performance has been from a cultivation standpoint relative to your capacity. We publish every month the performance of our facility relative to the rooms that we had online and the design capacity of those rooms. And as we completed the second quarter, we actually had to update our design capacity for our Appleville facility because we had outperformed our original design capacity by 35%. And in July, we outperformed our updated design capacity. After increasing it by 35%, we still outperformed by more than 10% in July. That, I believe, is a very relevant metric for investors to look at, because then you have a sense for what people are actually able to cultivate relative to their design capacity, and that should allow investors to understand what production will be going forward. The second most important thing is then your marginal cost of cultivation, because your gross margin and EBITDA is really determined by what your production was, what your revenue is, and therefore what your price needs to be in order to achieve full sell-through, and then what your actual cost of production was. So my perspective is that the highest value businesses should be businesses with very meaningful capacity and a low cost of cultivation. And our cash cost of cultivation in Appleville in the second quarter was 78 cents per gram.
What do you think it takes for a global cannabis company to be successful?
Well, I would actually say that thus far there haven't been any successful global cannabis companies. And I would say that because we don't yet have global cannabis companies that are actually generating earnings for their shareholders. So the first answer to that is that it's not something there where you can look to the market and see success right now. But what I believe it takes to generate success in this market is execution capacity and the ability to move at a strong pace. So as I noted, we went from 5 tons of capacity in January to more than 50 tons now quite quickly. And we've done a lot of things over the course of that limited period of time as well. So pace is incredibly important. And then having the right products and having the right approach to partnerships is also incredibly important. Because if you're in a brand new industry and you're growing very quickly, it's very difficult to do everything on your own. And it's possible to try, but as I said, there is not yet an example of a successful global cannabis company because there aren't any really significant cannabis companies generating meaningful earnings yet. And therefore, from my perspective, it's a situation where if you partner with others across the world, then you're more likely to end up in a position where you can move quickly and generate success.
Now, the company, as you said, is growing very quickly. As you're executing on your growth strategy, what do you see as some of the biggest challenges and opportunities for the company over the next 6 months to a year?
The biggest challenge with growth at the moment is growth itself. So going from a business with a few hundred people to 800 people now was challenging. Going from 250 kilograms of cultivation in October of 2018 to 2,000 kilograms in August was challenging. But if you think about it, based on our design capacity and what we've said we're going to have this year, in 2020, we'll be producing 12,000 kilos a month. So when we look at August versus months in 2020, we still have to grow by 6-fold again. So as a business from October of 2018 until now, from a cultivation standpoint, we grew 10-fold. Well, we have to grow 6-fold from there again. And it's just growth that is really the most challenging thing, is actually doing everything very quickly, building all of the processes, procedures that you need in order to be successful, adding the people at the pace required, and scaling up a company and a business at a pace that is necessary in order to be a meaningful industry player, despite the fact that we started as a relatively small cannabis producer in January of 2019. The greatest opportunity is the fact that this truly is going to be a global industry with a brand new, it's a global industry that has the potential to disrupt almost everything. Even if you just look at the alcoholic beverage market and you exclude everything else, and I'm not saying that that's the right thing to do, it's just a worthwhile example. We're going to have beverage products shortly with a known onset, so you know exactly when you're going to start, when you're going to feel the effect of the product. You are going to have a known offset. You're going to know what the effect is in advance. You're not going to end up with a hangover. You're not going to end up with liver damage. You're not going to end up with meaningful calories when you consume this recreational product. From my perspective, that's transformational. You take the alcoholic beverage market, which hasn't faced any legal recreational competition to their government-enforced, essentially monopoly on the recreational experience market up until this point, and suddenly they're going to be competing with a product that I believe dominates what they have. No calories, no hangover, no potential for negative social interactions. No one's going to go and get in a fight as a result of the consumption of a cannabis beverage. When you look at all of this and you think about the ability of cannabis to simply disrupt the global alcohol market, that is amazing. And that's just one component of the potential of cannabis. The medical potential of cannabis is absolutely exceptional. When I talk to people that I know from the military and they consume cannabis for PTSD, that's transformational. And it has a massive impact, in this case, on just a limited number of people. But seeing the impact that you can have on the small community of veterans in Canada, for example, well, that's a global opportunity, and that's only one use case. There are so many more potential use cases for cannabis from a medical and then health and wellness standpoint. So I think it's difficult to comprehend for people who aren't participating in the industry the scale of the opportunity. And it's difficult to comprehend the level of disruption that will occur to other industries as a result of the legalization of cannabis from a recreational standpoint as well as from a medical standpoint. And one thing that I've observed is many people look at the adoption of recreational cannabis in Canada and believe that the same pace of adoption will occur elsewhere. So they believe that it'll take quite a long time for governments elsewhere to end up allowing recreational cannabis. But I think what they're missing is that once people have seen a very successful approach to the rollout of recreational cannabis from Canada, and once people see, for example, the impact of beverages, cannabis beverages versus alcoholic beverages, and people from around the world come to Canada and experience cannabis and experience recreational cannabis, then there are all these people who can go back and pull this from their government rather than simply waiting for it to occur. And they can point to a very successful model and a very successful rollout. And I've heard people say that the Canadian rollout was unsuccessful, but I think they're absolutely wrong, because I think they're using the wrong metrics to evaluate success. The Canadian rollout was incredibly successful because the only complaints were about lack of supply. You didn't end up with any involvement there was no illicit involvement, and that was a key component of what the government wanted to achieve. You didn't have a whole host of people getting sick. The downside was avoided by the government having a very conservative approach to rollout. And as a result, it's possible now for other governments around the world and for citizens around the world to look to Canada as an example of how to do a great job of rolling out recreational cannabis in a conservative way that didn't result in any of these potential downsides.
We have covered everything I have prepared for our conversation. Is there anything else you would like to talk about?
No, I think that covers everything for me. Thank you so much for the time.
Yes, thank you very much, Andrew. It was a pleasure speaking with you.
Okay, have a great day.